Today we're talking about Crowdstrike earnings. They reported 50% plus growth, but the stock's down today. So I'm going to talk about why the stock is down and what I'm doing with the position in my portfolio. Do I think it's a buy? Do I think it's a hold? Do I think it's a sell right now? Let's cover it. We're tracking this portfolio. I am building a $1 million portfolio right here transparently on YouTube and sharing every step of the way. We started the portfolio on February 15th, 2022 with $10,000. I have added $88,460 since then, so added quite a bit because I thought the market had sold off quite a bit, and we're at a current value of $89,530. So we're up about $1,000, which is up 2%. If you followed me, you've seen the portfolio go down, you've seen it go up, and now it's pulled back a little bit. I'm not concerned with this stuff at all. As long-term investors, we should be focused on years, not months. Overall, the portfolio, if we look at total return, we've got Snowflake is up 30%, 31%. Rocket Lab's up 13%. But over the last week, it's been pretty rocky, right? I mean, Snowflake is still up over the last week. Rocket Lab is up, but Crowdstrike's down 6%. Datadog is down. Gitlab's down. Almost everything else is down, okay? So we've seen the market pull back quite a bit. If we look today, CrowdStrike just reported earnings. This is what we're talking about today. The company just posted incredible revenue growth, but the stock's down 5%. I'm going to talk about why right now. So here are their numbers, and it's a lot of words here, but the important thing to take away from this is on Seeking Alpha, is that they beat analyst expectations for non-GAAP earnings per share. They had 36 cents, they beat by 9 cents. They beat on revenue expectations. They posted $535 million in revenue, and they beat by 18.6 million. They also added a strong amount of new customers, 1,741. They increased their guidance for Q3, and they increased their guidance for 2023. So why is the stock down? This is really what the move down in the stock comes down to, in my opinion, is what the chief financial officer said in the report here and kind of how the call went. CrowdStrike delivered robust growth at scale and exceptional unit economics with over 80% year-over-year growth in operating and free cash flow. We are raising our guidance for fiscal year 2023, which reflects our technology advantage and strong industry tailwinds, combined with a, here we go, pragmatic view of our current macroeconomic conditions. Additionally, we remain committed to delivering increased non-GAAP operating leverage and 30% or more free cash flow margin for the full year. So they increased their guidance, they beat their current guidance, but they have a constructive or a pragmatic view of the current macroeconomic conditions. So they didn't increase their guidance as much as Wall Street would have, and analysts would have liked them to, and they did mention a difficult macroeconomic scenario, which everyone knows about. And so the stock underperforming in the short term or being down in the short term, it's literally a result of 1 to 2 sentences plus, the guidance not being as strong as people would have hoped. But what I do is I look at the long-term view. What I'm concerned with is how are the underlying business fundamentals? Are they continuing to grow and win market share? Or do they have strong customer signups? And then is it at a generally fair multiple? And I'll talk about the price of sales multiple in just a minute. But everything in this report, the revenue growth, the EPS beat, their gross retention, their dollar-based revenue retention, all of those numbers are very strong and in elite category. They had, I think, over 98% gross retention of customers. They had 120% plus dollar-based revenue retention. Those are elite numbers, okay? So everything, in my opinion, is going well with this business. And so it's just a matter of Wall Street not liking the difficult financial environment or macro environment. Plus, it is trading at a pretty premium valuation. So if we jump over to Fast Graphs, the blended price to sales ratio of CrowdStrike right now is 23.48. We can see that over the life of this company being public since 2019, they have grown sales at 54.5% per year on average. Their normal price to sales ratio has been 36, so it is below its normal price to sales ratio. But it got wild and extreme after COVID. It got all the way up to 59, a price sales ratio of 59, 48. That's just way too high for this stock. And what that did was that brought up its normal, its average price sales ratio. It's much more realistic around 24, around 27, even in the 20s, right? And so that's where it's at now. And I think the stock is pretty fairly valued right now. You can see this green dot right here is actually my buy price and where I bought. I bought at around a price sales ratio of 20.7 at today's revenue numbers. And so a little bit below today's price sales ratio of 23, right? And I bought the stock, a while back, but this just shows my cost basis essentially, which you can see right here in my portfolio. Average share price, 170.32. Okay, a lot of numbers, a lot of lines here. I'm gonna explain this, all right? This is a forecast of potential revenue growth for CrowdStrike moving forward. That's what we have off the bottom here. We have analyst expectations for 2023 of about 50% revenue growth. For fiscal year 2024, 36%. Fiscal year 2025, 31%. Fiscal year 2026, I put this number in, but I'm slowly bringing revenue growth down to 28%, then 25% in 2027, then 23.6% in 2028. These numbers are not right. They're going to be different than this, but it gives us a baseline and a way we can build a potential scenario, okay? And in 2028, which sounds like a long time, but it's fiscal year 2020 is 5 years from now. That's not that long if we're long-term investors. I want to own companies longer than that. But in fiscal year 2028, if revenue is growing 23.6%, I'm comfortable with around a price to sales ratio of 10 as a baseline for the stock. It could be a little bit higher, it could be lower, and then obviously the revenue number is going to be different too. But all we could do is build baselines. So if that's our scenario, from the stock price today to a price to sales ratio of 10 in 2028, which is a drop from 23 today, so that is more than a 50% reduction or contraction in the price sales multiple. So even if that contracts more than 50%, you still get an 11% annualized rate of return for a total return of 76%. Now that's not hundreds and hundreds of percent over the next several years like we might be used to seeing or expect to see after some of the craziness in 2020, but that the market on average does about 8 or 9% per year, and so this would be beating the market over that time period. Now, what could change that scenario? Well, if they post stronger revenue than these forecasts, then your return would be higher if it's trading at a price sales of 10. If they miss revenue, maybe they start to get disrupted, there's more competition, whatever, then the price is going to be lower. And so if we want to give like a 10% buffer either direction, then we can go up to a price sales ratio of 11 in 2028 would be about 13% annualized growth for 93% total growth. If we want to go down 10% to a price sales ratio of 9, then we get an annualized rate of return of 8.8% for a total return of 58%. So to me, that's a good range, somewhere between a total return of 58% to 93% between now and 2028 is what I think is, one of the probabilities for this stock and for the returns, and that's why I own shares. I think that they might beat expectations, and over a longer term, even longer than 2028, the business will still continue to perform, which is why ultimately I own the stock, right? I like that scenario in my portfolio, and this is how I think about the potential returns out to 2028. I will continue to reassess. I'll look at it every quarter, and I'll let my email subscribers and anybody following the portfolio on Savvy Trader, here it is. Again, you can go here. It's the link down in the description, and subscribe to get SMS updates or email updates after I make transaction in the portfolio. If you want the deep dives and if you want emails before I make any transactions, the best way to do that is austin.substack.com. This is my email newsletter. You can get it there. All right. Last thing we'll do is not just me talking. Let's look at what other people think about the stock. Morningstar is a pretty respected agency. They have CrowdStrike at 3 stars, trading close to fair value, which I think it is trading close to fair value right now. They have the fair value at 196. a narrow economic moat and exemplary capital allocation. Quick comments on their report, which came out yesterday after hours. They said they posted strong second quarter amid macroeconomic uncertainty. They're maintaining their fair value estimate. We believe customers will continue to rapidly adopt CrowdStrike's endpoint security platform to alleviate security complexity, while CrowdStrike benefits from locking customers into its ecosystem in the longer term. At the same time, we think that CrowdStrike's current market price has this leadership position, strong growth prospects baked in. We view the firm's share as fairly valued. There you go. That's Morningstar's opinion. So if you like this content, do me a favor, like the video, subscribe to the channel, hit the notification bell so you never miss an update. I will continue to share my portfolio with you and let you know how I'm doing regardless of how good or bad it is. Drop a comment with the stock you want me to check out, and I'll do a subscriber review stock this week or next week on the channel.